Hey folks, welcome to a product review at Finominal. Today we're going to look at momentum ETFs trading in the US stock market. Now, momentum is a very simple strategy and effectively simply hold or overweight the outperforming stocks and you underweight or ignore the underperforming stocks. And most investors actually kind of dislike the strategy for its simplicity. Now, you can enhance the strategy, for example, by using other metrics to improve the selection process. For example, Alpha Architect uses quality metrics to do so. Craft uses AI in terms of identifying momentum stocks. So there are, of course, some nuances that you can do instead of simply literally picking the outperforming stocks. So let's investigate in terms of how similar or different those 5 ETFs are. And what we're going to look at is ETFs from Vanguard, iShares, Alpha Architect, Craft, and Invesco. And we do see that there's a significant difference from a number of holdings perspective, in a sense that the product from Vanguard, with the ticker VFMO, has 723 stocks. So it is much more diversified than the other ETFs. Especially the one from Alpha Architect, QMOM, or the one from Craft are quite concentrated. Now, from a portfolio perspective, we can see or review if those ETFs are actually providing momentum characteristics. And so if you focus on this style box, we do see that relative to the S&P 500, actually all provide fairly high momentum characteristics. And that is kind of surprising, especially for the product from Vanguard, which has 723 stocks, right? That it is actually able to provide fairly high momentum exposure despite having a highly diversified portfolio. The other similarity that we see is that most of those ETFs have stocks that rank high from an EPS growth perspective. And naturally, there's a link between earnings momentum and price momentum. So that's not so surprising. Having said that, we do see that those ETFs differ from a quality perspective as well as from a valuation and market cap perspective. We can complement this kind of like holdings-based factor exposure analysis by also looking at a returns-based factor exposure analysis. And so the last kind of like 6 years, we do see that all of them have a high exposure to the momentum factor. And interestingly, almost all of them have negative exposure to the low volatility factor, which kind of makes sense because momentum stocks, the outperforming ones, think of NVIDIA at the moment, they also tend to be quite volatile. Now, we also do see that one product kind of differentiates itself by having the highest exposure to the momentum factor, which is the product from Alpha Architect. And we can attribute that to it being very concentrated with only 50 stocks, as well as using an equal weight, which does result in this high factor exposure. Now, from a performance perspective, we do have the returns since, well, 2019, right? So roughly around 5 years, 6 years. And we do see that actually none of them consistently outperformed the other ETFs. However, we also do see that the product from iShares, which ironically is the largest momentum ETF with about $15 billion of asset under management, that it kind of almost consistently underperformed the ETFs. We do see that with a time period, right, the product from Invesco, as well as the product from Craft, right, that they have outperformed, but it's not consistent, right? So you kind of have to really challenge that there is, challenge the current return. Now, from a risk perspective, we can also analyze the Sharpe ratio. So let's first look at volatility. We see that 4 of those ETFs are somewhere between 21 and 25%. So they have a similar amount of volatility. Again, which is surprising, right? Because the product from Vanguard has 723 stocks. So you'd expect it to be actually far less volatile, which is not the case. The one product that does differentiate itself here is a product from Alpha Architect, again, probably because of the portfolio that is quite concentrated and eco-weighted, that has a much higher volatility. And given that the high volatility is not associated with a high return, actually QMOM does feature the lowest Sharpe ratio. And so we can look at the Sharpe ratios, right, which we do see over here. So the Sharpe ratio of QMOM was 0.55. The other Sharpe ratios are somewhere like all over the place, 0.66, 0.62. And the one product that achieved the highest Sharpe ratio is the one from Invesco with 0.91. What's kind of interesting here is to realize that artificial intelligence, which Craft is using in the stock selection process, actually hasn't helped to generate a higher Sharpe ratio. And in fact, actually, that product had the worst drawdown. So it seems to be that AI hasn't done much for stock selection process, at least in this case so far. So this is in terms of those products on a kind of comparative basis. So we've seen that there wasn't any consistent winner here. They all offer high exposure to the momentum factor. But then, of course, the question is, like, has the momentum factor done well over the last few years? And so as a final step, we're simply going to take the best performing product, which is the one from Invesco, and benchmark it simply versus the S&P 500. And so here we have a track record that goes back to 2015. So we have about 10 years. We do see that, well, there's a kind of like slight outperformance since 2018 of this momentum-based product versus S&P 500. But we really only see it kicking off since 2023, and this is largely, or this can largely be attributed to the outperformance of the Magnificent Seven, and we can look at that in terms of from an overlap perspective. So this product has a 33% overlap with the S&P 500, but if you look at the holdings, especially the top 10 stocks, we do see that this Invesco Momentum ETF, that it has, significant overweights in the kind of like stocks that have been outperformed significantly over the last year, right? This is Amazon, Nvidia, Broadcom, Meta, Eli Lilly, and so on. So that kind of summarizes our perspective of momentum ETFs. So we've seen when we looked at five kind of quite popular momentum ETFs that there wasn't so much differentiation from a performance perspective. We can see they all provided high exposures to the momentum factor, but we also see that the momentum factor, hasn't done so much for investors until recently. And that simply highlights that factor investing is cyclical as markets, and that it's a factor that you can use, right? But probably it's best combined with other factors to harvest risk premium from different sources. That's it from a product review. Hope that helps. Have a nice day.